Sorry to keep you here on a nice evening right before the long weekend. Wasn't my idea, I can promise you that. But we've got only one subject today, a technical one, a difficult one, tranches. But hopefully we'll get out before the end of the full time. So you can all go into the long weekend. So tranches. Tranches, before we start with tranches, let's recap some of the most important underlying concepts. So last time, I think you learned about CDS indices. And CDS indices, if you want, are kind of special cases of baskets of CDS, right? You just take a bunch of single names, put them into an index, and then you trade the index as a whole, as a single contract. Okay, and now for tranches, be a bit more flexible and just think of general baskets. So later on we want to think about, so we're going to be thinking about tranches on baskets of CDS, but they don't necessarily have to be index portfolios, they could be any type of portfolio. Okay, and now if you're trading a basket of CDS, then each name that's in your basket represents a risk to that basket, right? And each name, if a name defaults, he will cause you a loss according to its weight inside your basket. Now with iTrex main or the standard kind of baskets we trade in the indices, we know that every name in the basket has an equal weight, namely equal to 1 over the number of names in the basket. So for iTrex main, there are 125 names in the whole portfolio. So each name itself has 125th, so a bit less than 1% of exposure, so that each default in the index causes a loss of whatever that name's loss is, 1 minus the recovery of the name, divided by 125 as a percentage of your basket notional. Okay? So for example, if we assume that a name defaults with a 40% recovery, the loss on the index from that default is going to be 0.048% because that's 60% divided by 125. Okay? And so if we accumulate more and more losses, if more and more names default, each individual one has in a way a linear impact on the basket because we just have a linear exposure to each individual name. And if we sell protection on the index, we're naturally exposed to losses. And if we buy protection on the index, we actually receive the losses. Right? So I think so far, nothing radically new. So what's the point of trading baskets or like indices? So maybe the biggest argument for trading indices is diversification. Right? If you have the choice if you have to invest money and you have the choice of of choosing one name that you invest your money in, or investing in 100 names, but in each 100th of your money, and let's say they all have kind of the same risk profile, then you'd much rather do that because your expected return is still the same, but your risk diversifies, right? So your P&L volatility on any basket is naturally much lower than the volatility you'd expect to get on any individual name, even though they're spreads, so your returns might be the same. Okay, but an index, if you've now created an index basket, you still in a way only have one risk-reward exposure at your available at your disposal. So imagine iTrex main trades at 100 basis points. Okay? And imagine you're a hedge fund investor who has been told, we expect you to make an annual return of 5%. And here's $100 million to invest. Then you, of course, can't just go out and sell protection on iTrex main because you would only get 1% every year. Now, you could, of course, lever up and trade 500 million of iTraxx main, then you would get sort of 5 million, which is 5% of your assets per year. But you're now running a very high default risk. Your maximum loss is 500 million euros, and in fact, your investors might say, or the person that deals with you might say, we're not going to let you do that. Or take the other extreme. Imagine you're a pension fund, and your return target is much more conservative. You're not trying to outsmart people. You're just trying to make a steady income. And let's say you have figured out that what you need to return is 0.5% to match your future liabilities. And let's say you also have $100 million to invest. Then iTraxx main trading at 100 basis points means that you could just invest half of your money in the index to get your return target, your 50 million. But sorry, you could just invest 50 million to reach your return target. But in a way, that's not very efficient because you're not quite happy with that because you'd rather have found a way to put money into this portfolio without being exposed to defaults. With this 50 million, you're going to lose on every single default in the portfolio. And so that's in a way a deficiency of an index, which just gives you linear default exposure to the underlying basket. And that's where tranches bring in a lot of flexibility. So, for example, a 0 to 10% tranche on any basket takes exposure from 0 to 10% of losses in the index. Okay? That means, just like with the index itself, you start to incur losses from the first name onwards that defaults. But after 10% of your basket is lost, your tranche is wiped out entirely. Okay? So your tranche is much more risky than the underlying index. The opposite is a 10 to 100 tranche, which works like this. You say, the first 10% of losses in my index don't affect me, and I only start to lose money from the 10th percent of losses onwards, and then if the whole portfolio wipes out, so 100%, then I'm wiped out as well. That kind of exposure is less risky than the index exposure because you only start accruing losses after the index, 10% later. And so you'd naturally expect the spread or the return you would get for selling protection on the equity tranche to be much, much greater than the spread you would get on the index, which in turn should be much greater than the spread you should earn on the super senior tranche, the 10 to 100. Okay? So if we go back to our previous intro example, think again of these two investor types, a hedge fund and a pension fund. Imagine the asset iTraxx main trades at 100, and the 0 to 10% tranche might trade at 500 basis points running, and the 10 to 100 tranche might trade at 55 basis points running, right? So we have that kind of hierarchy. Now the hedge fund will be quite happy probably to sell 100 million on this equity tranche because the spread is 500, so he precisely matches his return target by selling the protection on that tranche. Now his maximum loss is just 100 million he has, so there should be no problem in executing that trade. This is in a way what we call non-recourse leverage. So it means in a way you have, of course, kind of levered exposure to the underlying losses because only after 10% of the portfolio losses your position is wiped out. But the notional of your trade, so the maximum you can lose, is still just 100 million. Okay? And what about the pension fund? The pension fund might be quite happy with this 10 to 100% tranche because there he can invest a little bit less, like 90% of his notional, in this 10 to 100% tranche to meet his 0.5% return target. And now he doesn't even have any exposure to losses, at least not the first 10% of losses. Okay, so these are classic examples, and they're actually very close to how people trade tranches in reality. And these are the main motivations behind why it makes sense to tranche up portfolios. It's just to meet individual investors' risk-reward targets. And as you can imagine, for a bank or for a market maker, the tranches, the 0 to 10 and the 10 to 100 together are just the index. Right? So as a bank, if I have the hedge fund client and I have the pension fund client, and both of them are selling me protection on the tranches, what I end up with, if it's done in the correct sizings, is just index exposure. And then I can trade the index and be neutral, or I can trade the single names and be fully neutral. Okay, now in the universe of tranches, we differentiate two types of tranches. We differentiate bespoke tranches and index tranches. By the way, tranches sometimes are also called collateralized synthetic obligations, CSOs. As opposed to CDOs, collateralized debt obligations, which you may have heard. So everything we're talking about is based on CDS and therefore synthetic, right? Which means we're not in a funded world of like bonds or loans where you have to put money on the table on day one. Here, everything is synthetic, derived from some underlying bonds, and there's no exchange, there's no funding required. Okay, and so the bespoke. So how do bespoke tranches work? In a bespoke tranche can be literally any tranche on any portfolio. And that was the way the market operated before the financial crisis. So some client would say, I would be, let's say, some investment manager does research on the German auto sector, decides, I think this sector is rock solid, but the spreads on offer are kind of low. To juice things up a bit, let me take a bespoke portfolio of the German automakers and ask JP Morgan to sell me protection, to buy protection from me on a 7 to 8% tranche of this basket. Because clearly it's much more levered, much more risky, and you'll get much more spread, but if your view is that they're going to be fine anyways, maybe you want to do that. And 7 to 8% tranche, if you have, let's say, if there's 10 names in that portfolio, you can kind of stomach one of them defaulting, and you're still fine, and you only take losses if the second one defaults. Right? So these type of trades were very, very common before the crisis, and then banks would make markets in these type of products and try to hedge the risks over the lifetime of each trade. Of course, that's very, as you can imagine, that's very difficult because these risks are very nonlinear, and so as a result of the crisis, regulators said, you know what, we're going to make it very capital intensive for you to do this kind of activity. So this activity nowadays is much, much smaller in magnitude than it used to be. On the other hand, index tranches differ from bespokes in that the underlying portfolios are the standard index portfolios on which we also trade indices and options. And index tranches, in a way, bundle everyone's attention and thereby liquidity on a few well-defined tranches. So there's iTraxx main, the index, there's iTraxx main options, and there's iTraxx main tranches. And that has a lot of benefits because that means there's easier netting, there's less counterparty exposure, but there's of course also a bit less flexibility. But index tranches nowadays are the main way market participants trade tranches. Okay, and so what does the menu of index tranches look like? In Europe, we trade them on iTraxx main and iTraxx crossover. Don't know why it doesn't say that here. So you can add that in if you want. It's definitely main and crossover. And in the US, we trade them on CDX IG, CDX high yield, on the loan CDS and the loan CDS index. And we normally, not only is the portfolio standardized, in a way, what we call the attachment and the detachment points of the tranches, so from where to where you incur losses, these are also standardized. So in iTraxx main, for example, everybody trades on the iTraxx main portfolio the 0 to 3% tranche, which we call the equity tranche, the 3 to 6, the mezzanine, junior mezzanine, the 6 to 12, the senior mezzanine, and the 12 to 100, the super senior tranche. Okay, so equity most risky, junior mezz second most, senior mezz third most, super senior least risky tranche. Okay, and so for example, if you look in the markets, at a time when iTraxx main, the index itself trades at 72 basis points, a real life example would show you that on the equity tranche, the 0 to 3, you would earn 1,041 basis points, so basically 10% running. On a junior mezzanine tranche, you would earn roughly 2 to 3 percent running. On the senior mezz, you would earn 114 basis points, and on the super senior, roughly half of the index spread, 36. Okay, so on all of these tranches, you earn more than on the index, except for the super senior, where you happen to earn half. And so that is a natural kind of spectrum of spreads that is now opened up to investors who may not be happy with just the outright risk-reward profile of the index itself. Okay, now let's visualize what happens to tranches as losses accrue in the underlying portfolio. Okay, so imagine, for simplicity, that names, when they default with 40% recovery. Okay? And let's say we're looking at iTraxx main, so there's 125 names and equally weighted. So think of a 0 to 3% tranche, so the equity tranche, and a 3 to 6% tranche, the junior mezzanine. The first default causes 60% loss, which on the index equates to 0.48%, right? As we saw before, because there's 125 names. Now, 0.48% of index loss for the equity tranche actually means 16% of loss. Why? Because the equity tranche is fully wiped out after 3% of the index is lost. So 0.48 is almost a sixth of that, right? 0.48 divided by 3% gives you these 16%. Which means that if there's a default with 40% recovery, the buyer of protection on the equity tranche will receive 16% of the tranche notional he traded from the seller of protection. Okay, so a very substantial amount, just after one name. And now that, on the other hand, the 3 to 6% tranche, there's no exchange of cash flows yet. And now imagine there's a second default, and the third default, and the fourth default. Each name contributes linearly to the index loss. So it gets interesting after the index loss reaches 3%, right? And that's after the seventh name defaults. So after the sixth, the index loss is 2.88%. By now, the 0 to 3% tranche is almost wiped out entirely, whereas the junior mezzanine still hasn't incurred any losses. But now with the seventh name, the equity tranche is completely wiped out, and the junior mezz starts to take first losses. Okay? And if you say 7 times 0.48%, that gives you a portfolio loss of 3.36%. Now 3.36% that is 0.36% of loss on the junior mezzanine. And the junior mezzanine is wiped out after 3% of additional losses. So that equates to 12% of a loss. So 12% of notional loss on the junior mezzanine. Okay, and then thereafter it goes very fast, and after another 6 names defaulting, after the 13th name defaulting, the junior mezzanine tranche is also wiped out. Okay? So now we've completed the picture for us to see how risky each tranche is. Basically, the equity tranche is risky from the start, in fact very risky, and after 7 names it will be completely wiped out. The junior mezzanine tranche only starts to incur losses after 7, but is wiped out after 13. Okay, so now you've got a feeling for sort of the riskiness of these tranches, and now you can go back to the market and say, okay, so this equity tranche, okay, each name is 16% of a loss of notional, but you know what, if nothing happens, I get 10% each year, right? That's the spread. In fact, you kind of get 10% a year anyways, right? So you need one, if there's one loss every year, you don't break even, you lose out. But if there's less than a loss every year, the chance is actually quite high you're going to make money on it. It's just very risky. Okay, so much to that. There's one more tranche worth knowing, which plays a special role in the market, and that's iTraxx's S9 tranche. So right now, just for context, the indices can trade on versions on version S29. Remember, every 6 months we introduce a new version. It all started in the early 2000s. So now we're at Series 29. And Series 9 is significant because it was issued in March 2008, just before the whole financial crisis really kicked off. And the index tranches, initially, their main purpose was actually for banks to hedge the positions in their bespoke books. So this S9 tranche was issued when the bespoke market was in its prime, if you want. And so the S9 tranche coincides best with the portfolios that were issued at the time and with the maturities at the time. And so the S9 tranche is still outstanding and actually very actively traded. It's just that even its 10-year maturity is going to mature in June this year, and then we'll only be trading on the run iTraxx tranches. And tranches roll once a year, not like the index every 6 months. So in a way, we skip every other index roll and only introduce new tranches on the even numbers of index series, just to bundle the liquidity a bit better. Okay, now how do we come up with these tranche spreads? How do we kind of decide whether a tranche spread is fair or not and compensates me properly? I mean, we kind of have a feeling for the defaults. Like we know now how many defaults it takes to really impair them or wipe them out. But how do we kind of properly price them? Now, what are the natural inputs into that you would expect for tranche pricing? Of course, what are the spreads of your underlying single names? So what's the portfolio risk in your basket? That for sure is going to be a main driver of the tranche riskiness. Then how much time is there left to the maturity, right? Because say a tranche with only little time left is less risky than a tranche with a lot of time left. Interest rates always play a role, discount factors, because you're going to get certain payments at different times in the future, so that plays a role. And then very importantly, the attachment and the detachment point of your tranche, right? We've kind of easily convinced ourselves that a 0 to 3% tranche is probably going to warrant a much higher spread than a 10 to 100. And so to formalize the pricing, we're going to introduce the tranches loss. So far we've only spoken of the portfolio loss of the basket, which is just a linear function in the number of defaults. But now we can also define, of course, the loss of each individual tranche. And it's just formalizing what I hope is intuitive by now. Where's the Minsky? So the formula you see there, it's just a fancy way of mathematically expressing the simple fact that a tranche incurs no losses up until its attachment point. We call it Z. Okay. And then all the way up to its attachment point, so K. All the way up, and then it goes linearly all the way up to 100% where it's wiped out. Right, so bit of a hockey stick function. So that's this is your tranche's portfolio loss. As a function of the portfolio loss of the basket itself. So now what we want to know in a way is how risky is the tranche, i.e. what's the expected loss to this tranche. Okay, so we've got the payoff diagram of the tranche as a function of the portfolio loss. Okay, so how do we normally price things? Well, the expected tranche loss is just the integral of all the possible portfolio losses multiplied with the tranche loss in each case. Right? That's just the expected value of my tranche's portfolio loss. And we know how to parameterize it. It's just a hockey stick function of the portfolio loss, but from the attachment to the detachment. Okay, so this is the way we could mathematically express that. Now, the difficult bit about this is, though, where do we get the distribution of our portfolio loss ZT from? Because we can back out what ZT's expectation is. We know what the underlying basket itself has, what kind of risk is priced into there, because we have the spreads of all the single names in that basket. So we get the expected value of ZT, but we don't know its distribution. So the challenge about tranche pricing is really to come up with a model for the distribution of the portfolio losses, from which we can then price the tranche losses with the help of this formula. Okay? Because imagine two situations. Imagine now imagine two portfolios with two different distributions, but the same expected loss. Okay? So imagine one portfolio which is kind of centered around a portfolio loss of 15%, kind of symmetrically, and another portfolio that's centered a little bit further to the left let's say around 5%, but has the off chance of there also being 90% of portfolio loss. Now, both of these portfolios, both of these distributions can have the same expectation, namely 15%, which means that if you just look at the spread of the two baskets, the spread would be the same. But if you price tranches on them, you will get to very different results. For example, if you think of a senior tranche, then a senior tranche, so let's say do we take an example here? No, but think of a 40 to 100 senior tranche. Okay? 40 to 100 is extremely unlikely to happen in tranche A, so in portfolio A, right? Because there's no hump there or nothing, and the probabilities, the implied probabilities there are very, very low. But for the second portfolio, I mean, the 40 to 100 tranche will still probably be not worth a lot, but it will be worth something because there is a definite chance priced in that there could be 90% of losses. Okay, so the distribution on the right would give higher prices to senior tranches over equity tranches, and the one on the left would give higher risk to equity tranches than senior tranches. Now, what's the most important concept with which we kind of want to move between a distribution that looks more like the left one versus one that looks more like the right one? That is what for that we use correlation. Right? And correlation in tranche pricing plays pretty much the same role as volatility in options pricing. So correlation is in a way the single parameter we want to use and think of intuitively to price our tranches. And so the portfolio A could be the outcome of a distribution with fairly low correlations. Because portfolio B, when you have having a chance where 90% of your portfolio wipes out, that's an event that is only really possible if 9 out of 10 names or 90 out of 100 names default, which by definition is a highly correlated event. So to get to a distribution like the one on the right, you would need a very high correlation, whereas the one on the left would be reflecting a low correlation world. Okay? So that's very important. Low correlation means defaults are isolated, they happen here and there, but they don't really have knock-on effects on other names. So many, so isolated defaults that can happen in high quantity. Now, high correlation, on the other hand, means that there's a high chance that defaults happen in conjunction with each other. So either everything in the portfolio defaults or nothing defaults. It's kind of like a more binary world, right? Where, let's say, if you think of a portfolio with one automaker, one industrial, one tech company, and one bank, that would probably be a fairly lowly correlated portfolio. I mean, yeah, one of them might default, but there's no real reason to believe that they should all default together. Whereas if you took a portfolio with 5 tech companies or 5 banks, you'd think, oh, actually, the chances of all of them defaulting together is probably much more highly correlated. And they probably, I mean, given they all share the exposure to the underlying sector in line, if the sector does well, chances are high that none of them are going to default. If the sector does poorly, chances are high that all of them are going to default. So correlation naturally should be priced higher. Okay, and so that has very important, that has very significant repercussions on tranche pricing, and therefore correlation is really very important in this context. Okay, let's put some numbers on an example just to drill home the point. So 2 portfolios and 2 tranches, a 0 to 10 and a 10 to 100. This is, in a way, is a numerical example of the situation we described here, went through visually. Okay, so think of 2 tranches, an equity and a super senior, 0 to 10 and 10 to 100. And now let's think of 2 portfolios. In the first portfolio, 50% chance that there will be 5% portfolio losses, and 50% chance that there will be 15% portfolio losses. So the overall expected loss of this portfolio is 10%, okay? Which means that, for example, a 5-year index would probably trade at around 200. And what about tranches? If there's a 5% loss, the 0 to 100, the 0 to 10% tranche is half wiped out, right? So half of its notional is lost. And if there's a 15% portfolio loss, the tranche is wiped out completely. Okay, so with a 50% chance, half of the tranche is wiped out, and with a 50% chance, the entire tranche is wiped out. What does that mean? That means the expected loss for this tranche, so the expected tranche loss, is 75%, and the average of 50 and 100. What about the senior tranche? In the case where 5% of the portfolio defaults, the senior tranche doesn't take any losses. Right? And in the case where 15% default, the senior tranche takes some losses, few losses. Because 15% is 5% above the attachment of the 10 to 100, and 5% over the tranche width of 90 is this 5.6% of notional that therefore gets lost. Okay, so in one case, 0% loss, in the other case, 5.6% loss, both happen with 50-50 chance. So the expected loss of the senior tranche in this case is 2.78%. Okay? So a very, very risky equity tranche and a relatively unrisky senior tranche in this scenario. Now, yeah?
Sorry, where does the 0.6 come from, the 5.6?
It's 5.6 is if you've lost 50% of the portfolio, in a 10 to 100 tranche,
Yeah.
you've made 5% loss on 90, or on the width of 90. So 5 divided by 0.9 is this 5.6. Okay, now take a second portfolio where there's a 90% chance that there's no portfolio loss whatsoever, but a 10% chance that the entire portfolio gets wiped out. Okay. The expected loss is exactly the same as in the first one, 90 times 0 plus 10 times 100. So the index would trade at the same level as the first portfolio, but let's go through the scenarios for the tranches. So if there's 0% portfolio loss, both tranches will of course take no losses. But if there's 100% portfolio loss, both tranches will take full losses. So both tranches actually have the same expected loss of 10%. And that means even though we're looking at an equity and a super senior, in this kind of world, both tranches actually have the same risk. Are priced to have the same risk and the same risk as the index, because there's only one scenario of default where everything defaults, and so it doesn't matter whether you're long an index or any kind of tranche. Okay, so the second portfolio clearly is a very, very highly correlated portfolio, whereas the first one is much more dispersed, less correlated. And you see that when correlation is low, equity tranches are very risky. The expected loss for the equity tranche in the first portfolio is far higher, 75%. Right? Because in the first portfolio, the equity tranche takes losses in every scenario of the world. Right? It's very likely that one of the names defaults. It's just not likely that all of them default. And on the other hand, the super senior is very solid. And in the second scenario, the super senior is much more risky, and the equity actually less so, because there's now a very high chance that the equity survives in full. Okay, so high correlation means senior tranches get riskier and equity tranches less risky. Low correlation has the opposite effect, means that equity tranches get very risky and senior tranches less risky. And one more. So we've had a visual example, we had a numerical example, and now one which I'm not a massive fan of because it's kind of a military example, but it can help as another way of thinking about it. So if you think of a minefield with a set number of mines, so here let's say 5 mines, and there are 5 lanes through which you could travel through this minefield. The distribution of the mines to us is kind of so each mine, triggering a mine is like a default event. And the distribution of the mines represents a highly or lowly correlated world. Okay? So in a highly correlated world, let's say all the mines fall into the same lane, and in a lowly correlated world, all the mines are kind of dispersed around, and let's say each lane has 1 mine. Now, the vehicles, let's say there are 2 types of vehicles that could maneuver through this, that could try to maneuver through this field. One is a bicycle and one is a tank. Now, the tank to us is kind of the super senior tranche, because the tank could, in a lowly correlated world, so where the mines are just dispersed, the tank can just drive through because 1 or 2 mines don't actually hurt him. So the tank much prefers that kind of world. Whereas for the bicycle, that's terrible because the bicycle suffers if even one of them hits it. And the exact opposite is the case in the highly correlated world. The tank now actually stands a chance of losing, because of getting blown up, because if he chooses the wrong lane, he suffers. So the tank much prefers the low correlated situation, whereas for the bicycle, the highly correlated one is gives it much greater chances to get through, because in the lowly correlated one it has no chance, and in the high correlated one there's a chance 4 out of 5 that it chooses the right lane and kind of manages to find its way through. Okay, so that's an analog to how correlation impacts the different tranches in different ways. Okay, and so there are 2 types of correlation that are important in the pricing of the tranche. One is the dispersion, or if you want, the realized correlation of your portfolio. So that's essentially how dispersed the spreads are in your portfolio. So if you have a portfolio where every name is trading at the same spread, that portfolio has little correlation, realized correlation. We would say it has very little dispersion. Whereas a portfolio where some names are very tight and some names are very wide, that would be a highly dispersed or highly correlated, sorry, the other way around. That would be a highly dispersed or lowly correlated portfolio. Okay, so that's one measure of correlation that's important and will affect tranche pricing. And the other one is implied correlations, i.e., what do we expect correlation to do in the future? Now that is really kind of the equivalent of implied volatility. So dispersion, imagine you're given the task of pricing up a tranche. The dispersion you cannot control, because the dispersion is just the result of the underlying portfolio spreads. So you just look at those spreads and say, okay, there's a certain amount of dispersion in it. But then you can overlay it with your view of implied correlation in the future, and that is in a way the parameter we want to tweak to express tranche prices, and that's the parameter people track to judge whether tranches are expensive or not at any point in time, just like people track if volatility is high or low in the option space. Okay? Now, let's think about tranche sensitivities. So, what factors are our tranches sensitive to? In a way, the factors that determine its pricing. So as we've seen before, the most obvious one is just the general level of spreads, right? If your portfolio gets riskier, your tranches get riskier. Each tranche at the end of the day is still just a vehicle where you either go long or short credit risk. So spread risk naturally affects tranches. Now, of course, correlation, we've just discussed, correlation will have an impact on your tranche. So if correlations go up or down, depending on what kind of tranche you're looking at, you'll have different exposures. And default risk, what happens when a name defaults, tranches can have very different exposures, right? And default risk now is not just a kind of a linear thing anymore. A mezzanine tranche will not have any default risk immediately, like if the first couple of names jump to default, but will have very high default risk once a few of them have defaulted. So default risk is still very important and actually less straightforward than with an index where it's just linear. And time value. So like in any fixed income product, how do you expect your tranches to move over time, let's say given nothing else changing? So let's talk about the first one first. So the sensitivity to general levels of spreads. Now, I think it's pretty intuitive that the riskier a tranche is, the more sensitive it is to the absolute level of spreads. Right? So an equity tranche, if portfolio spreads, if everything widens at once, an equity tranche will see a pretty big change in its price, because suddenly the chance of it seeing significant losses has become a lot higher. And because it's the riskiest tranche, it also has the greatest sensitivity to spread moves. And that progressively decreases the further out you go in the seniority spectrum. So equity riskiest, junior mezz second riskiest, etc., down to super senior. Now, how should we measure this riskiness? A good way is through a delta equivalent. Remember, delta in an options context is essentially what position would you need in the index to offset a move in your tranche to first order, so that you're in a way market neutral against any small spread moves on your combined portfolio. So this concept of delta is just to calculate it. You calculate how does my tranche move when spreads widen, divided by how does an index move when spreads widen. And that gives you a factor of what kind of notional you have to hold in the index to be delta neutral. And so if you calculate that for the iTraxx tranches, for example, you'll see that your 0 to 3 tranche, the equity tranche, has a very high delta of 6.8 in this example. Okay, so what does this mean? It basically means that a tranche, in terms of its sensitivity to spread moves, an equity tranche, will behave like 7 times an index position. Okay? And the junior mezzanine will still behave like 4 times. The senior tranche will still behave like 2 times an index. But actually the super senior, as should also be kind of intuitive, the super senior will actually move by less than an index will, right? Because it's less risky. The spread is also lower. So here the delta drops below 1. So the super senior would only need a fraction of index against it to be delta neutral. What about correlation exposure? So we've convince ourselves correlation is bad for senior tranches and good for equity tranches, which means that correlation exposure for senior tranches is negative and positive for equity tranches, right? But what about mezzanine tranches in between? So for mezzanine tranches, it's less obvious. And in fact, it changes over time. So some mezzanine tranches will have positive correlation exposure, some mezzanine tranches will have negative correlation exposure. In general, the exposure is actually fairly small in absolute terms, but it basically depends on whether your expected loss is above or below the attachment of your mezzanine to determine whether it behaves a bit more like a senior or a bit more like an equity tranche. Okay, you can think of it a bit as like the expected loss in your portfolio being a bit like the at the money level, to use the option equivalent, and then any tranche that attaches before it is in the money, any tranche that attaches behind it is out of the money, and out of the money tranches are a bit more like senior tranches, and in the money tranches are a bit more like equity tranches. Okay, so that's kind of the way you can think about it, but most important point, correlation exposure for equity tranches is positive, for senior tranches negative, and in between it's mixed. Okay. Now, default sensitivity. What happens to a tranche position when there's a default? So we've seen the default profile for the portfolio loss, right? Now, that's at expiry of the tranche. This is your precise exposure to default, right? In the beginning, let's say if you're looking at a mezzanine tranche, in the beginning it's 0, later it's linear, and then it's maxed out. Now, before you expire, you still have some exposure to losses, even though let's say you're in a mezzanine tranche and no name has defaulted yet. Even though the first default will not hurt you, you won't have to pay out anything, but your tranche will reprice because suddenly your tranche looks a lot riskier than it did before. So there is still default exposure. It's just much tougher to quantify because you have to reprice your tranche after one name has defaulted. So nevertheless, the default exposure is of course still by far the highest for an equity tranche where it triggers immediately a payoff than for the more senior tranches. Okay, but so important to know that default exposure is not 0 for a mezzanine tranche or a super senior tranche, because anytime a name defaults, you are getting closer to being impaired in your tranche. Now, if that happens to a name that has already traded very wide in your underlying portfolio, then in a way that chance has already been priced in, and the impact will be lower than if it were to happen to a name that's been trading very tight. So where the implied chance of default has been priced to be very low. But nevertheless, for both of them, there is, for all tranches, negative default sensitivity. Okay. And now what about time value? So time value is a bit tricky. Remember, for an index position, the two main sources of time value are carry and slide. Right? So your index, when we calculate time value, we say from being long, how much money do I collect each year, assuming that spreads don't change, or assuming that we roll down a curve. And that's the index time value. And so the index time value, when you plot it out, normally is pretty much a straight line. What about tranches though? Tranches, if you think of an equity tranche first, an equity tranche, does an equity tranche become significantly less risky a year into a trade? So think of a 5-year equity tranche, a year into the trade. The index rolls down a curve, so actually makes quite significant amount of time value from rolling down, and there's 4 years, only 4 years left after a year, so it becomes much less risky. What about that equity tranche though? The equity tranche in a way is very prone to jump risk, right? At any point in time, the equity tranche suffers if any name defaults. And now that's the type of risk that doesn't roll very fast. So, if tomorrow, if we were trading an index or a super senior tranche that expires in 2 days' time, we would both agree that's pretty much worthless. That the spread of that would be close to zero. But what about an equity tranche? I mean, it's not impossible that tomorrow a company like Steinhoff comes out and says, sorry, actually there's been fraud and we have to file for bankruptcy. Jump is still worth something. And so that's why equity tranches roll very slowly. That's what you see on the top right-hand side. So if you're looking at a 0 to 3% tranche, that really rolls slowly and only accelerates late into its life. And if we think next about a senior tranche, for a senior tranche, it's almost the exact opposite. For a senior tranche, if you think of its time value, senior tranche reflects the value of a lot of names defaulting together, right? So if time passes by and nothing has happened, the value of an event like this happening decreases very quickly. So, because it's in a way, you think of it as a far out of the money option, the less time you have available for that to materialize, the less valuable it is, and significantly so. So senior tranches are the opposite of equity tranches. They roll very fast. And also think of it, senior and equity together must effectively be the index. So if one is slow to roll down, the other one must be fast to roll down. And mezzanine tranches are kind of in between. As always, they are similar to the index. Okay, but that's an important concept to realize. Okay, and now what about delta hedged tranches? Delta hedging tranches is another popular way to trade them, just like people like to delta hedge options. So when people delta hedge options, they normally try to trade the volatility that the option was priced with and express a view that the volatility that the option was priced with is too high or too low relative to what you think the market will realize. Delta hedging tranches, in a way, does the same thing, except that instead of trading volatility, you're trading correlation. So, because what are delta hedge trades? Delta hedge trades, by definition, are market neutral for small moves, right? You're putting a position in an index against your tranche position such that for small moves, your portfolio shouldn't change. But if any of the other parameters of the tranche pricing changes, like correlation, you do have exposure because correlation will move the tranche part, but not the index. Okay, so delta hedge tranches are the way you can trade correlation, and therefore it's worth quickly going through how a delta hedge tranche trade behaves. What are the sensitivities of that? But first, so let's say you've decided you think correlations are too high and you think correlations are going to drop. What would you do? You would sell protection on a tranche that benefits when correlation drops, so a senior tranche, right? And if your view is solely on correlation, you would delta hedge to be market neutral and buy protection on the index. So then if correlations fall, your super senior becomes less risky and you profit. You could also buy protection on the equity and sell protection on the index, because there the correlation exposure is just the other way around. So then if correlations fall, your equity protection becomes more valuable and you profit, and your index doesn't. I think the example that is described on the slide is the other way around, but that shouldn't matter. Okay? Okay, so that's pretty clear. Delta hedge tranche, correlation exposure, let's say we're selling an equity protection and buying index against it, correlation exposure is positive. Correlations go up, that's good for us. What about everything else? So let's go back to this picture here. The leverage, we're missing the spreads. Okay, let me explain it this way around first. Let's talk first about senior tranches. Okay, so let's say you think correlation is going to drop, so you sell protection on a senior tranche and buy index protection against it. Page 24. So correlation exposure negative. Now, look at this chart. What you see here is that the delta of your tranche is 0.6. Okay, so you're buying 0.6 times index protection against your tranche. What's the spread of your tranche? The spread of your tranche is 36, right? You see that on the bottom here. The bid is 35.25, the offer 37, so your average is roughly 36. So the tranche, on this tranche, you're carrying 36 basis points running. On the index spread is 72. When you buy protection on the index, you need to hold 0.6 times the index notional, 0.6 times the carry of the index, 72. It's actually more than the 36 basis points you have on your tranche. You get on the tranche. So your time value is negative. Over time, you lose money. Nothing happens, right? So that's interesting. That's not obvious. So effectively, your delta is higher than the ratio of spreads. That's why your time value is negative. What about jump to default exposure? Jump to default exposure, if there's a default in any of the names, it impacts your index position. It doesn't yet impact the tranche. So that's positive. Okay? So in a way, you can say you're owning jump protection, but you're paying for the jump protection with negative time value. And what about convexity? So remember, your delta at the moment is 0.6. What if the spreads widen out substantially, imagine like spreads go very, very wide, your tranche becomes as risky as the index at some point, right? Because if spreads are extremely wide, your tranche is just like the index. If all names default, you have the same loss on the tranche as you have on the index in the most extreme case. So your delta actually goes up the wider spreads go, and it goes down the tighter spreads go. That means your convexity, if you keep rebalancing, is negative, because if market moves wider, you have to buy more protection because your delta has gone up. And then if it moves back lower again, you sell the protection again, but at a lower level, so you've lost money. So convexity, that's what we call convexity, is negative. So in a way, the more things move around, the more money you lose through the rebalancing of your delta. Okay, so that's an example. So your short correlation, your negative convexity, you have negative time value, but you own jump. Okay? So lots of things going on with the delta hedge tranche trade. So it's not a linear trade by any means. And if you now think about an equity trade, the equity trade is in many ways the inverse of the tranche trade when delta hedged. Because you can think of an equity tranche as just index minus super senior. So all the derivatives, like the delta, like the convexity, or is just the complete opposite. So convexity here, if you're selling protection in equity and buying index against it, your convexity is positive. Why is that? Because your delta, remember your delta is really high initially. And your tranche is very risky, much more risky than the index in the beginning. You have like holding maybe 6 or 7 times index against it. But what if if spreads really widen out a lot, suddenly whether you're holding an equity tranche or an index doesn't really make a difference, because if everything defaults, all of them are equally affected. So your delta goes down as spreads widen towards 1. So here, as a result, if spreads widen, delta goes down, you buy protection low, spreads come back, you sell protection high, you're buying low, selling high, you're actually making money. That's what we call positive convexity. And time value is positive as well, because if you go through the same exercise as with the super senior, you'll find that the delta of your tranche is, in this case, actually lower than the spread ratios of tranche and index. Now here, your correlation exposure is positive, right? Because now you're long an equity tranche, so you'd rather for correlation to go up. But your jump to default exposure now, naturally, is negative, because if there is a default, it's going to hurt you a lot on the equity, and you'll be covered a little bit on the index, but not enough. Okay, so the delta hedge equity tranche is one where you have positive convexity, positive time value, but negative jump to default. So if you think of markets right now, I'm not sure how familiar you are, but right now we're in a world where spreads are very, very tight, but companies are doing well, because companies can issue bonds, issue debt, and at very cheap levels, the central bank buys their bonds. So nobody's really expecting companies to default, at least not many, not in grand fashion, over the next couple of years. So actually this kind of exposure, but we might drift wider, right? There might be moves in sentiment. So this kind of exposure is actually quite nice for people, because in a way you can have positive time value and positive convexity, which is normally something you only get for being outright long. But in this case, you're market neutral. So positive convexity and positive time value in a market neutral trade, in return for giving up jump to default risk. But if you say, if you're not concerned about default risk or jumps, then you say, okay, you never get something for free, but I'm happy to trade convexity and time value against jump. So that's the profile of a delta hedged equity. Okay, let me see. Let's do a 10-minute break and then finish up with the last 3 sections? Or do you want 15 minutes? No opinion means 10. Okay, I'll see you at 20 past. Yeah.
Quick question about something.
Yeah.
Going to write a thesis about CES, and I was wondering if there was something to
Right.
because I think it seems to be
Yeah.
and I wonder if there's some sort of correlation between book and market.
It's an understudied topic, but people are starting to look into it. So, AQR has published a paper on it not long ago, and there's a little bit of literature generally on kind of factors. Mostly, I think most people look at corporate bonds rather than CDS because for a lot of these empirical studies, people want a very long time horizon to really get comfortable with any results. And bond markets have been around for 100 years plus, but CDS only for let's say 20. So I think that's why in the CDS market you won't find much dedicated literature, but bonds, which should kind of give you similar results. Bonds you should find a little bit, but not much. So if you're doing research on that, it's definitely
So it's not that we have the requirement for it to be like so I could technically still use the CDS spreads.
Yeah.
I was just wondering, I wanted to particularly focus on the slide part of it.
Yeah.
Doing forward. While it's more, it should be the reverse of the value chain, right? Because there should be the higher to market should result in the smaller spreads. Think about it. So there should be some sort of a strategy where you would long the company with low decline.
So it would be really interesting to see if you can sort of historically take the 100 names in main and select the ones that have I guess normally they make these kind of portfolios, right? Trade those with high value score versus those with low value score and see if it's kind of a strategy that consistently performs.
But it does make sense on a first point. It's sort of like
No, it doesn't totally make sense. Yeah, I mean, normally the motivation behind value is, well, it's just that it's sort of a
proxy for other things, essentially.
Yeah, people say it's the market is kind of undervaluing it, right? Underpricing it. Maybe the value measures. This particular definition is kind of an equity definition. Maybe in credit markets you're looking for something a little, you could maybe choose to change the value metric a bit, because this is price, this is market capitalization of a book value basically, right? It's kind of an equity concept. Maybe what you want to look at is maybe the spread versus spreads of names with similar rating.
So
it's kind of like
all relative terms.
Yeah, so kind of which name has sort of has an implied low value or implied high value by the credit market itself. Maybe that's the. I'm not sure. I'm just guessing. Maybe that will have more predictive power for subsequent credit performance than an equity signal. But those are the kind of questions that I guess are worth investigating with an open mind.
And in terms of macro do you think
to find the determinants?
Yeah. Because if we take, for instance,
Yeah. Yeah.
the overall additional
Yes. So something that correlates very well with credit spreads is equity volatility, like VIX. Because if you think of credit is a bit like, if you think of a simple sort of structural model of a company, a creditor effectively has effectively sold a put on a company's assets, and an equity holder basically has a call on the company's assets. So the value of credit largely is dependent on the volatility of the asset prices. So if equity vol goes up, that's normally a bad thing for creditor. You can think of it this way: creditor has only limited amount of money to make, but you can get your money back, and that's the best case scenario. But you have everything to lose if whoever you lend to goes bust. So vol or uncertainty generally is bad for creditor. So yeah, so growth normally is a good thing. Yeah, growth can correlate, but I think more you'll find a better fit with. Sure. Yeah. Hey. Hi.
I wanted to ask you, how do you submit it? More like some associations, some charts, basic calculations, which
Yeah. To be honest, I'm not sure because we told the procedure was for the coursework we don't actually mark it. The coursework is marked by somebody from Imperial, and we told them how to mark it.
Oh, yeah.
So I actually don't know how they want to submit it.
But you're aware of it?
Yeah.
That's what I mean, because I couldn't put it in a Word file because it's just basic formulas and calculations of bases and stuff like that. So like, there's not much there I can write. So should it be in an Excel sheet, you think?
Yeah, that works. Yeah, that works.
The second question is, so the first question is, you didn't write any notional amount.
Yeah, so it's just essentially the numbers of one.
So that if the notional were 100, exactly.
You know, for the complexity insurance, I mean,
Yeah.
complexity, the statistic delta, sorry, the statistic of tranche change, but
The sensitivity of delta to spread. Yeah. No, index.
delta to the interest rate. I think it's just a bit confusing too.
I mean, the direction will be the same, right? Because index spread or trans spread going up or down is the same thing. It will just have slightly different. But yeah, the direction, so the direction and the sign would be the same.
Do you mind if we go through the jump and fold one more time? Because I
Yeah.
think what is-
Right. So imagine so on the delta hedge charge or just in general?
generally, that's
Okay, so if you're let's say at maturity of a tranche, so you only have 1 day left. if let's say you've sold a 3 to 6% tranche and nothing has defaulted in the index, you're at the last day of the life of the tranche. If tomorrow, if one name defaults, and let's say your portfolio loss goes from 0 to 1%, let's say this is 3%, yeah, let's go from 0 to 1%, your P&L doesn't change, right? Because you're not going to use this on that one. But if this happens on the first day of the 5 years, you'll actually think, oh shit, you know what? One name defaulted. I don't have to exchange any money today, but now the chance that at some point in the future I will has gone up.
So there'll be a jump.
So your P&L will be negative, like on that through that event. It won't be. It will just be a mark-to-market event. Like your position will be considered more risky by the market subsequent to an event, but you haven't had to exchange cash because you're not in the 3 to 6% region yet. It's just that 3 to 6. It's the same, right?
Yeah, the seller wouldn't.
So for the seller it's good and for the buyer it's bad. So both of them have a jump to default. One has a positive one and one has a negative. Yeah, exactly.
Yeah, last year
Yeah. No, it's the same. It's the same direction. It's just that for the equity tranche, your jump to default is straightforward because you immediately have to exchange cash. For the equity tranche, if there's a default on right now, that means I have to pay out that default. So it's an actual cash flow event. Whereas this one is a mark-to-market event. That's in a way the difference. But some people think that you have 0 jump to default in a mezzanine tranche because you are not exchanging cash flows. But that's not quite right. Your position will definitely move if there's a tranche. If there's a default, it's just a market move rather than. Okay, thanks. Sure.
We need them when they're thirsty. I remember our tactic to it, so we were playing all the time.
All right. Okay. Let's continue. So, we're going to finish with some comments on historical tranche pricing and themes in the tranche market. And then we're going to go through some of the nitty-gritty details of the mathematical pricing of tranches. Okay? So tranche pricing, I hope we're now clear, is heavily reliant on correlation. Okay? Implied correlation in particular. And so just like we monitor the implied volatility and how that moves over time, and how we can look at time series of that and sort of read off from it when the market was extremely fearful. Looking at charts of implied correlation tells us a bit more of a nuanced story about when the market was seeing defaults as likely to occur in the correlated or less correlated fashion. So one interesting example is the 2005, the so-called correlation crisis that happened back then. that was triggered by downgrades to General Motors and Ford. They were downgraded to high yield, I think in close succession or maybe even simultaneously. And that caused a big shock to tranches and a big repricing because the market had actually been quite strong, and people were very heavily exposed to equity tranches because strong economy. People thought defaults are not going to happen, and certainly not in a they just thought defaults aren't going to happen, and then suddenly these downgrades and which meant that people were comfortable selling equity protection. So you would only sell equity protection if you're really kind of confident that there's going to be very few defaults in the market. So that happened to quite a large extent, which then means that correlations rose, right, just to make those equity tranches tighter. But then this downgrade of GM and Ford triggered a big rethink, and suddenly people got very scared of potential defaults. And so these equity tranches that had been sold in great amounts, suddenly people wanted to get out of very fast. And so the equity tranches fell, which meant that correlations fell quite drastically. And so we went from a relatively high correlation environment to a low correlation environment over the course of a few months in 2005, and that's what people nowadays call the correlation crisis. And somewhat ironically, I mean, this was just sort of fear of idiosyncratic defaults here and there, which drove these correlations very low. And as a byproduct, low correlations means senior tranches. So suddenly people were worried about equity tranches, but priced all the risk out of the senior tranches, so that 3 years later, when the financial crisis started to erupt, you started off with correlations around 10%, extremely low, and very, very cheap super senior tranches. At that time, super senior tranches would have cost you like 1 or 2 basis points to trade. Oh yeah, actually there's a spread chart down there, like less than 10 basis points before the crisis, because correlations were low, so people said there's absolutely no chance that super senior tranches could ever be impacted, and people started selling super senior protection on huge leverage, so like 200 times levered, because how are you going to make money out of 5 basis points running? You're not, unless you can find, let's say, 100 times leverage, and then 5 basis points becomes 5%, and it doesn't look so bad, is what people thought. But then the financial crisis erupted, and suddenly people worried about large parts of the economy being very, very overvalued, vulnerable, because what if a bank goes bust, and then suddenly all the companies that rely on transactions going through that bank go bust, or all the financial counterparties of that bank go bust. Suddenly people were very worried about like high correlation events, and correlation spiked from 10% up to sort of 50-60%, which meant that the super senior spreads went from, let's say, 5 to up to 80-90, which, again, if you're just doing super senior if you're thinking of like an unlevered portfolio, you can take a loss of 1 or 2%, but if you had it 200 times levered up, you're probably getting some calls from your counterparties saying you need to provide more. You need to provide more collateral, and most likely you're not going to have enough, and you have to unwind. And so that sparked a real ripple through the whole tranche market. Arguably made things worse than they should have been. But if you look at the correlations, ever since then we've not come back very much. So. Yeah, even nowadays, when you look at correlations in our markets, we're effectively still at levels that you saw since the financial crisis, especially in Europe, because you can imagine after 2008, 2009, there was not much time for relief in Europe. We went straight into the European government crisis, where people worried about Eurozone breakups. And Eurozone breakups is the kind of risk that that also warrants high correlations, because Eurozone breakup, what if there's a split of currencies and companies, all countries go back to their home currency, but or let's say Italy spins out of the Eurozone. Italy goes back to the lira, but all of the Italian banks have debt in euros. So if suddenly their revenues are in liras and the lira depreciates, how are they going to service their euro debt? So these type of events are naturally events where people envision highly correlated defaults potentially, and therefore our correlations have never really dropped. Which means that we're still living in a world where when you look at super senior tranches in Europe, they trade nowadays still quite expensive, or quite wide, because they're pricing in a lot of risk, compared to the US. In the US, we don't have this kind of high correlation anymore. In the US, it kind of went up and then came down again. So very different pricing. Then on the other hand, some people say, now the correlation is so high, I feel like the worst is over for the Eurozone, we're kind of normalizing. And then you look at high correlations like this and you say, maybe it's a risk premium that I should pick up and sell super senior protection against delta. So right now we have kind of in a world where I would say there's both sides of the argument, and things are probably going to normalize somewhat. Okay, but now let's get into some maths, because it's Friday evening, and that's what you do. Okay, so tranche pricing. We still haven't really discussed how we could mathematically, or let's say in a spreadsheet or something like that, really kind of from first principles come up with some toy models for a tranche price. So we're going to try to do that now. Remember, the big challenge in a way is to come up with a way to model the portfolio loss, the distribution of the portfolio loss of any basket, if we're given its expected loss. So we're given its expected loss from the underlying spreads, but we need to come up with some distribution so that we can then integrate the payoff of the tranche over that distribution. Okay, the most simple approach that still leads to a closed form solution that I'm familiar with is the so-called Vasicek model, which relies on, so in the first instance, on a simple argument about credit risk that goes back to Merton, where you say it's not an unreasonable assumption in a toy model to say that for a firm, you can think of any company as essentially consisting of assets and debt. And bankruptcy takes place when the assets, which you think of as kind of a volatile quantity, right? Like assets could reflect profit and other volatile things. Assets can fluctuate. Your debt, is stable. But if your assets drop below your debt, that's kind of like a default event. And what is kind of a reasonably decent assumption for asset price processes, something with a diffusion, something normally distributed, maybe log normal, is probably not a bad idea. And then let's say we model default as the time when our asset process falls below the debt. Yeah. So if we assume that asset prices are log normally distributed, we can then translate that statement straightforward in a pretty straightforward way into just a closed form function for the probabilities of default for an individual name, right? Because we say we know default happens if assets fall below a certain threshold. The assets are normally distributed, so the default probability is going to be a function, a sort of something that we can calculate with a standard normal distribution function. And that's the function 6 on the bottom of this chart. So now let's say we found a way to parameterize the term structure of default for a certain company. The next thing we want to do is we need to bring in, that's just company by company. Assume we have managed to do that. The next thing we need to do is correlate things, right? Because we realized, we kind of want that correlation parameter in there somehow for our toy model to reflect the intuition we've built up. Okay, so how do we do that? So we want to, if we say all of our asset processes or the normal distributions that determine default, let's say they have some correlation structure, and for simplicity, let's just assume the correlation between them are constant. And next, let's say, to help our intuition a bit, let's say your assets are a sum of idiosyncratic effects and macro effects. Okay, so if you take two standard normal variables and you take a linear combination with a square root of a correlation, you're ending up with a new random variable that again is standard normal. So x defined as square root of correlation times y, which is our market factor, plus square root of 1 minus correlation times epsilon, which is our idiosyncratic factor. That again is a standard normal variable, except that we've now parameterized it with a correlation and a market factor. Okay, so now think of our assets, think of plugging that back into our asset process. So now we can express the default event as something that has an idiosyncratic component and a market factor component to which we are correlated in one way or another. Okay, so if we plug that back into our formula for the probability of defaulting, we'll find that the probability of defaulting is now a function that's expressed via the standard normal distribution function, but which also involves the level of the market factor and the correlation. And so what can you tell here already? So why is this correlation, why does it do what we expect it to do? So if you imagine that every company defaults when x drops below a certain threshold, and every x shares the same, every company shares the same market factor in common, then you can imagine if that market factor is very low, that means all company assets are dropping at the same time, and therefore reflecting sort of this correlated nature of default. And the higher your correlation parameter is rho in equation 8, the bigger the impact of the market factor on defaults. Okay, so far so good. So we've kind of expressed the probability of default of an individual company as a function of a market factor and the company's correlation to that market factor in a semi-closed form way. And what are we going to do next? Next, we want to bring things together, right? At some point, we have to say what's the distribution of defaults in the entire portfolio. So first, some simplifying assumptions. Because otherwise the presentation gets too complicated. Let's assume all the individual default probabilities are the same. and equal to something we call PT, so the probability of defaulting after time t. Just to make notation a bit cleaner. It's actually not necessarily required. You could do it in a general fashion. It just makes things a little messier. And then we define a random variable that jumps when there's a default. That helps us, that allows us to define effectively the loss process of our portfolio as just the sum of all the jump to default processes, L. Because now omega t, what we've defined here, just counts the number of defaults over time, right? Jumps by the proportion of names that have defaulted every time there's a default, and goes from 0 to ultimately 1. And what we're ultimately interested in is not so different from just this percentage of default process, because ultimately we want to know the index loss zt, which should jump every time there's a default, but not jump just by 1, but jump by the loss of that single name, because that's how it affects the portfolio loss. So we just have to bring in the individual names loss, 1 minus the recovery, but keep that format of 1 over n, sum of I equals 1 to n of the individual losses times 1 minus recovery of each name. And then we do one more simplifying assumption, which is to say, let's assume that they all have the same recovery, because otherwise, again, the notation becomes very messy. But also here, that's not really needed. You could carry it out in complete generality. And then your loss process, your portfolio loss, is just 1 minus the recovery times the percentage of defaults in your portfolio. Okay? That hasn't really helped us yet. We've just introduced terminology so far. Now, you can convince yourself that when your portfolio is very large, that the proportion of names that are defaulted at any point in time in your portfolio should just be the individual default probability given the market factor y at that time. I'm referencing Schönburger and Vasicek, who go through the exact details of proving that. But essentially, you can think of it as, what's the more names you have in a portfolio. So by the law of large numbers, the more names you have, the more the law of large numbers should apply, so the proportion of names that are defaulted should just become the probability of them defaulting given your market factor at any point in time. So, which means that now we can start to solve, if we assume that for a moment, we can then derive what the probability of the probability of our portfolio loss being less than or equals a certain amount is by plugging in the default probability, which is a function of the market factor. And since the default probability as a function of the market factor is just a function of the normal distribution, we can rearrange terms in there and again come up with a function that is just iterated functions of normal distributions. And that final function there is just the distribution of losses, the distribution function of losses of our portfolio. So we can now go into an Excel spreadsheet, plot that for different parameter values, plot the first derivative to see what the density is, and then we get charts like the bottom left and the bottom right, which show you, if you're choosing parameters, let's say, a probability of default of 40%, so think of that as like a spread quantity, a recovery of 40%, and a correlation of 40%, your loss distribution in the portfolio is what you get there, which is kind of a nicely distributed portfolio loss, going from 0 to roughly 60% and thereafter dropped off. But if you take the same parameters and you substantially increase your correlation parameter, you'll see that you're now modeling a world where the losses don't occur sort of just centered around an average 25-30%, but there's either a high chance of them all defaulting at once or a high chance of none of them defaulting. Okay? And so that's allowed us to basically, with a lot of assumptions on the way, but to come up with a semi-closed form solution to effectively price tranches based on a proper distribution of portfolio losses that underlies it. All right? Because the last step we will do from here is to now take this distribution of Z. So we've created our distribution of Z under an assumption about correlation. And now we could integrate any tranche payoff against that distribution and come up with a price. Now you can imagine in reality we want to be a lot more flexible. We don't want to assume that each name has the same chance of defaulting. We don't want to assume that each name would have the same recovery. But apart from that, to be honest, it's not very different from this.
I mean, you don't want to assume each, like, different names within the index to have, within the tranche to have the same chances of recovery, right?
Yeah, you wouldn't do that. And you also, in practice, people don't assume that you know the recovery in advance. What you price it with in reality is kind of a stochastic recovery model where you also introduce where you also make your recovery a function of the market factor.
What basis do you do like how would you know the difference between defaults between different elements of the portfolio? How do you work out that?
So they trade individually. So each name that's in your portfolio trades as a CDS out in the market. So you know its spreads, so you know its default probabilities, basically. So you use the implied default probabilities from the single name market. So that's in a way not a big hurdle to overcome. The main challenge is really to take in a way you have all the marginal default probabilities of each individual name. The problem is how do you piece them all together into a joint distribution of portfolio losses? Okay, so that's what this accomplishes. Okay, and one more thing to mention is the concept of base correlation. So if you Google, or if you ever come across it in a tranche context, if you look at pricing in tranche, you will probably hear the word base correlation. So tranches in the market normally, when they talk about the correlations used to price tranches, people talk about base correlations. Why is that? So what we've done in this example here, if we are told, so the way practitioners use these models is not really to come up with the right price. Normally, what we much prefer is to basically let the market trade in a product, tell us where the price is, and then calibrate a model to that price. So basically find the correlation parameter so that our model agrees with the market price. And then we've calibrated our model to the price. Now, the problem of doing that is the solution is not always unique. If you think of a mezzanine tranche, so this tranche here, if you think of the function of the price function of this tranche as a function of correlation, as we've seen, mezzanine tranches don't have a straightforward dependence on correlation. That's because, in a way, this mezzanine tranche is a combination of two equity tranches. This mezzanine tranche is one equity tranche that attaches at the detachment point, the attachment point. This should have always said A. This should have always said B. And one equity tranche that attaches at the detachment point. Now, each equity tranche has a straightforward dependence on correlation, because for equity tranches, correlation is entirely positive, right? So when a tranche has positive correlation exposure, it means you're always going to be able to find one unique correlation value to match a given price. But since a mezzanine tranche is the difference of two equity tranches, this one minus that one, it's no longer just an increasing function of correlation, but the dependency actually flips. Initially it's increasing, because initially the effect of the first equity tranche dominates, but then later on it becomes decreasing because the effect of your second equity tranche dominates. And that's why your tranche spread or your tranche price of a mezzanine as a function of correlation has this hump, which means you effectively can't find a unique solution of correlation to match any given price. So that's why people can't actually use this correlation concept for mezzanine tranches. And base correlations just reflect the fact that a base correlation is, instead of pricing mezzanine tranches, what we'll do is we'll just price a set of equity tranches. So remember in main we have 0 to 3, 3 to 6, 6 to 9, 6 to 12, and 12 to 100 tranches. Instead of trying to find a correlation for each of these tranches, we'll find a correlation for the 0 to 3, for the 0 to 6, for the 0 to 12 tranches with this methodology, which is then just unique. And that's what we call the base correlation. And once we have a set of base correlations from which we can back out all of these individual equity tranches, we can then also back out the mezzanine tranches, because each mezzanine tranche is just a combination of two equities. Okay? So that's the concept of base correlations, and that wraps up everything we wanted to tell you about tranches. If it's a deep topic, very technical, quite hard. It's probably the hardest part of the course. And you're not expected to be able to derive the Vasicek model, don't worry. But if you're interested, there's plenty of further additional material in the second appendix. And as always, if you have any other questions, just drop us a mail or chat to us, and then we'll see you next week. No, actually not next week, the week after next week. As in, like, not next Monday, the bank holiday, but the Monday after the bank holiday. Right? Okay. Have a nice weekend. You don't have to. It's So some people will be, because some part of it is kind of the pricing and being familiar with the structure where right and work for certain requirements. But you don't have to be a PhD. It's really like most of the technical. You have to be, I think you're expected to become familiar with it. So you're expected to kind of not be afraid. But and the message matters.
After the
traders will be investment. Oh, traders are the market. It's not the market.
the structures are more
That's it. If you understand that, you understand everything. So let's go through it again. Do you think this one is clear and this one's not, or do you think both of them are a bit unclear? Okay, so let's start with this. So why is it negatively convex? So convexity is how does your delta change when the market moves. So your delta, think of an option. An option normally has negative convexity, right? Okay. So here you're selling protection on a super senior tranche, which is basically the same. Let's say over here. You will earn if the market sells off, falls below. You don't care here, but you're gonna care. But let's say your delta is right now kind of derivative of your price. Now, the further you sell off, your delta becomes worth. So what does this mean? So let's say you've sold the option. So you have to short the stock. So as you come closer here, you have to short more and more stock because it becomes increasingly likely that you exercise the option. Just like when you've sold super senior protection, you buy index. The more the market sells off, the more you have to buy index to maintain your delta. But so that means, let's imagine it will go down, you come back up. You're selling lower, you're selling lower, you're selling more, the lower your price drops. And then on the way back, you're buying it all back again at higher prices.
Psychology,
You're selling 77. Your delta goes down when the market sells off, and it goes up when the market recovers. Which means your convexity is negative. It's bad for you.
Monday we're off.
So
Monday we're off.
to rebalance, when you rebalance your delta, you're losing money every time you rebalance.
Wednesday.
That's
Well,
what
still,
negative
long
convexity
weekend.
is.
Have a proper.
What are you doing?
That's the same with an option as with a tranche.
There's a lot to do.
So right now, a super senior tranche might have a delta of
I haven't
0.6.
started that.
Because your super senior tranche is much less risky than an index. But if every name in the portfolio defaults,
Wait, what are you doing?
you have the same impact on your super senior tranche as on the index, right? Both of them are fully lost.
Yeah,
Now, on your way there,
There's
as
lots
let's
of
say the
ways
market
to
starts to
balance
price in a scenario like that, more and more, your delta goes from 0.6 closer to 1.
There's also you have to think about
Because
regulation.
if they were the
where they
same,
have their
delta would be
license.
1.
There's so much information that we don't have access to.
So right now, if you're long the super
Yeah,
senior,
because
you're buying index
What are you
protection,
doing?
you're buying 0.6 of index notional.
Which one?
When the market sells off, so spreads go wider, you have to buy more protection because your delta is going up. Going close.
That's cool.
Buying more protection. But you're buying it at higher levels.
You can go work with them and do
Then imagine if it comes back, you're selling it again. Let's say you go back to the same place where you were before. You've lost money on the trajectory.
Oh, why did I not do
So
that?
delta goes up.
Why didn't I apply? I didn't jobs. I didn't apply.
It was a lot of
That's negative.
Yeah. Have you got a background in fintech?
No.
It's
Is Italian, they're Italian,
it's an advanced concept, but it's actually very for practitioners. So that's convexity.
Congratulations.
So convexity basically
That's as good as getting a
is
job.
like a small internship, no?
what does your delta go up or down when spreads widen?
Yeah.
No.
Don't be
With a super senior tranche,
no,
your
we're gonna
delta
get
goes
like
up when spreads widen.
with the fee
With
and
an
the-
equity tranche, your delta goes down when spreads widen.
Unsupervised project.
Okay, now time value. Time value means if you just hold this position,
I wanted to go away, but I was thinking actually.
do you make money or lose money?
So it's like I thought, oh, we could do a fight for anywhere in the world. I could go on holiday.
So if you've sold protection on senior on a senior tranche and you buy delta neutral amounts of protection on the index, it's not obvious whether you're going to make or lose money by doing that, because you've bought something, sold something else.
Look right, and I was thinking.
Now,
if I coded something, I'd be
that's
fine,
where
I would never know if it's
going back
wrong
to
or
this
right.
screen
I'll just be happy if you
helps. So remember, if you've sold 36, you get 36 basis point every year on the tranche. Now to be delta neutral on the index means you have to buy protection on the index against it in a notional that's 63% less. Okay, so if let's say you carry, so if you basically carry
So what is our
on the tranche,
What are they then?
it's your notional.
Like we can't do the M&A module. Like the only one we can do is company valuation. I've actually.
Per year.
The M&A module. Ah.
The index.
Can you send me the link?
And you receive that because you're selling
Okay.
protection.
Just like
The
the
index,
we have to.
it's your tranche
You
notional
have to
times
change
the
like
delta,
more
which
because
was
it's the MS finance
0.63.
something because we don't access it.
Oh,
Times.
yes.
I'll send it.
And the index spread is
That's fun. I got some MBA M&A slides.
72.
I was looking at it. I was like, I've never done this. Yes,
like
no, so I looked at Wall Street
DCF
Business.
or
Hours worth of
Now.
like, it's like a whole month, like lecture course.
This,
What did you do?
I'm doing,
This.
this time I'm doing
and this is
trading.
negative, right? Because you're paying.
This one and that.
This is greater than
My
36.
trading is.
Do apply trading.
Right, because 36 would be half,
I
but
did
this
it
is
so we can
0.6
get into trading, because I've never followed the
So,
markets. I've never actually.
you're
had
paying
to
away
trade.
more
I've
carry
never
than
done
you're
it, and I
receiving.
need like some guidance.
So that's why your time value is
You
negative.
did like coding.
It's coding.
But
So if nothing changes and you just hold it to
Yeah.
maturity,
That's the only reason I didn't take it. It's like
even though it's a delta neutral trade, so if the market moves a little bit, you're neutral, but in time value, your time value is actually
So
negative.
far, like in the exam, I'm not sure how much Python is going to be in it. It's not like some basic exam.
No.
It's not, so I don't think it can be so much coding or completely like multiple choice. But that makes me question
Yes,
what he's
so
actually doing,
based
so,
it's
like,
based on the spreads,
like,
right?
ours. Of
Yeah.
course, 50% is coursework, which is applied trading
Theoretically,
and
why it is
back testing
now
project and another one.
Yeah.
And then the other 50%.
So intuitively, why is it negative time
So
value?
every week we basically put in trades.
I would say
Yeah.
intuitively it's
And
negative
then we
time
also
value.
present, so basically we could
Because
do the code right now, so then
you-
start the trade. So I
You
know
own jump. So
he
time
has
value,
he has a code from his,
all trades have
from his
positive,
algorithm
like a trade
trading,
that has positive time
module,
value.
and he used that
must
code
expose you to
now
some
do
kind of
apply
risk.
trading.
You should do apply trading.
Normally that's always the intuition,
Like,
right?
it's
If you're collecting
So
from that
well,
carry,
in his group, he actually got
Um,
he's got
it's
100
because you're
stocks
taking on some
throughout
risk,
the
like
trade.
you're selling an
Well,
option
my
or
group
you're
is doing,
selling
like,
protection.
strategy,
Whenever you
like,
collect
I think this is gonna go up.
time value, you're
So we
taking
haven't
on some
exactly
risk.
done anything.
Here, it's the
That was
opposite.
the smart.
You're negative
So
time
it is
value,
not.
so you actually pay.
You need to do
Why are
it.
you
Oh,
paying?
thanks.
Well, you're
You're
paying
calling it-
because you get something in
Banks
return.
and
I'm
regulations.
so glad I
in this
took
case.
time.
Yeah,
It's
really refreshing.
Sleep.
Yeah.
It's
No,
macro.
because it's like
The
there's
negative
no
part,
math.
you make money.
Apply trading and this is hard enough. So at least it's something you can understand.
Because you sold protection on the super senior draft,
What about you?
but you bought protection on the index.
It's a few pages.
And the index, if there's a default, on the index it gives you a loss cash flow, and the super senior, not individual.
Gotta help each other.
Yes, we should.
So that's, I would say, the intuitive explanation, but if you just look at it, it's always like that in the I mean, these numbers might be different, right? 36, 72.63, but it will always be negative. So that in the way of all the
This is refreshing because my group is like, you have to design it.
and then the last one is a correlation
It's
experiment.
actually like speaking.
Correlation,
And they're very
correlation goes
like,
up,
Like I just met them today and they all seem pretty like.
you lose because you're along a tranche,
Yeah.
a senior tranche. So if correlation goes up,
He's got a Bank of England
the
guy coming in.
tranche gets riskier and you lose money.
It's just like.
But your index doesn't move when correlation moves up.
Yeah, what are you doing, Bob?
Well, this one, this one,
Yeah, because I was going to change banks to wealth, but then apparently.
That's what we mean with short correlation. So correlation goes up, you lose money. That's short correlation. If correlation goes up and you make money, that's what we call long.
yeah, the correspond,
Yeah.
that's the thing, yeah.
So then, so I was actually going to change because concept of banks was a bit less.
And then the equity tranche in a way is the other way around. So maybe it's a good exercise to go like try and explain it to yourself based on this example of the senior tranche. But if it's still not clear, write me an email. Okay? Sure.
Oh, I actually just wanted to ask about coursework because there's nothing on submission. Like, is it electronically submission?
So the other one of the colleagues asked me the same question.
Are we supposed to do it in Excel, basically?
Some of them I think it's better to do in Excel. Yes.
You don't have to code it up.
No, you don't have to. Yeah, I think you can do that. Let me tell the.
Because we're not gonna see you before the submission.
Yes.
On the Mondays of the lecture.
Exactly, and actually you're going to submit it not to us, but to somebody from Imperial, because we're going to mark exams, but not coursework. That's the arrangement. So it's somebody at Imperial marks. So we've told them how to mark it, but they are going to mark it. So I'm actually not sure exactly how the logistics will work of handing it in, but I will tell the person who organized the course to write an email to you to
You
explain
didn't give
it.
instructions that we should do it in MATLAB or Python.
I would have to ask Saul actually, because he wrote it. He wrote
I thought
it.
it says Lamel.
Oh.
Here we go.
Yeah, because I think it's kind of unfair to require people to have to code it up if you can do it in Excel.
Yeah.
So,
Oh yeah, I think
because I know some courses
I'm
are
almost certain you're more than it's more than fine.
do you have any more, like, I'd imagine you have to do it on your own, you don't have any example models of the basis pricing, you just have to do it
How's
even if you're very bad at Excel and don't know how to do it.
Yesterday, like last.
Are you expected to kind of make like a payoff profile for a negative basis trade? So
Before it was like a TED talk. It was literally sitting there and the guy like different surveys and structures and like.
yeah, I think that's part of the challenge is to try and come up with the chart that gives you basically this kind of
and not do any
this kind of chart, right?
Okay, phew, I got that.
But it's logic, like you have some inputs, right? You want to say, what's my bond price? What's my CDS up front? So,
What? Yeah.
In company valve, the
Yes,
one
yes.
that they put up that
Up
was
front.
the first is the 92-page one.
what's the coupon?
But it's like earlier years or something.
Is it okay?
But last year,
you get a bond coupon,
now it's 92.
maybe 3%,
PhD in Sangha.
and CDS is maybe 1%.
Okay, that's just too much.
And then you want to have
I'm
maturities.
glad.
Like that's where they push all the first down.
And then it should just
8 or 10 of us.
spit you out.
Yeah, no, it's not. Well, they have to average the pass of the year, right?
That's a fun project.
No, it's Excel.
Like, in comparison to people in like, yeah.
May I just ask, so
Yeah.
the question 2 that's on it's really straightforward, just like find work and only go on CDS basis.
Yeah.
I just wanted to clarify, sorry this might
Yeah,
sound
no,
very
sure.
stupid. So I understand the flat spreads are one that you quite remember.
Yeah, exactly.
And then do I have to find the password to calculate?
Oh, that's a good question. So, are you given the whole curve?
No, we're literally just given the bond coupon.
But doesn't it say, it seems, I have the paper.
Show me the.
I mean, it assumed zero.
Yeah.
How old is Carrot?
I don't know. She looks young.
Yeah, she looks so young.
And then Alex.
Yeah.
Sorry, the youngster.
Yeah, Alex is 27. Okay,
I would love to
so yeah,
So it's
I
literally
don't
just
with
the flat spread minus the.
I want them there.
And then you look at like, and then
Oh.
Yeah,
and then you get people like Sam, and like he's doing like this project on like exotic derivatives, and you're like, okay, so he gets the first. Wow.
Exactly.
The bond is explained.
The bond is.
But this concept has
It's the same. So the sorry.
it's setting the assumptions like that something has a flat texture.
Ah.
Oh, you know,
Oh, yeah, one
That's
percent.
just
Easy, just put some finance words
These
inside.
con-zero rates have a flat texture.
yeah, like chemistry is mathematical. But
Yeah, but that's only the interest rate. Yeah, that's not
This
the
is mathematics.
This is you
No,
get
because
some
it's like-
economics.
no, but it's more like quantum mechanics.
Like a lot of
like,
econometrics, like a lot of like stuff that's
no, nothing will
did a
come
lot of
from
math.
like it's quantum mechanics. It's like
My friend sent me like
modeling
a
how
picture,
particles
like
move. It's nothing to do with this. You can't.
that what we. My friend sent me a picture that what we're actually doing is rocket science. It was like, when people say, "Hey, finance isn't rocket science," financial economists can now answer, "Oh yes, it is." Robert Merton added equals them like to the DS model.
So it's a very good question,
Equals calculus.
because in reality we would do it from par spreads, but you're simply not given enough information to back out a par spread. Because to back out a par spread you would have to know a curve of CDS. But you're not given a curve, so you can't be expected to calculate the par spread. So, but I would mention it. I would say
Come from a zero
I would normally
to rocket science.
use the par spread because it's a slightly more accurate measure. But given the absence of
Yeah, so you can't compare.
term structure of flat CDS, I can't bootstrap that. So I'm going to use the CDS spread instead. And then if you did that in the exam, you would get extra points.
Can I ask one more question?
Yeah, sure.
Sorry, do you mind if I borrow your question? Sorry, I think it's. Yeah, so after you plotted.
I bet you knew
Goes
this.
everywhere.
Yeah.
So I on that, and then it says.
Guys as well.
When I joined this like talk, I had like a rough idea of how to like what a nerve. No, I didn't. I bet you
Does
knew
that
what a nerve
mean,
was.
say, when you plot it,
Yeah.
then
Now you're
training now.
okay, but then how does it
I
work?
want you to go like
I just like.
If I wouldn't give a fuck about the grades, I'd probably
Because if you
Yeah.
because it's the one
So this zigzag is already the reflection of the fact
No,
that
so I tried fixing colors.
actually it should be zigzag.
I looked at I applied it.
No.
Yeah,
That's what I thought for that.
Dripping down, jump up, dripping down, jump up.
Yeah, it was worse.
Because and this is the reflection of the fact that you don't get
She doesn't
one
use any
coupons.
more.
Wait, but it's
It was
the-
just like.
But on the CDS every day.
When she was explaining, she just used.
So if you're because you're buying the CDS and you're going
That
along the
was
bond,
very easy.
you're paying away a CDS spread every day, but you're only getting the bond coupon on these
Scares you
dates. So if there's a default
Then,
here,
like, I just kind of ignored it.
you would
I was like, I want a bit of
you
basic
would not
concept.
get this coupon, but you would have paid the CDS coupon from year to
Even
year.
if you don't know Python, can you do that?
A lot of people go to the
okay,
course
so
even though they
I
don't
don't
sign up for
think
it.
about
Louis is
But so
like
this-
100 guys and
Daniel.
buildings, just saying.
Correct, so
Yeah,
the
it's
recovery
not
and
like,
so the
even though
notion
it's
of
in
the-
this course.
So on the bond you get recovery, on the CDS you get 1 minus
I don't
recovery.
know, 'cause it
So
depends how you.
in terms of
you
notional,
can use
you just
Python.
get 100
You
back.
can use Excel and
Yeah.
numbers.
So I don't need to
Are you
like
using Visual or
that
Pro?
The
No.
whole thing is.
Yeah.
Oh, okay.
So in a way, if there's a default after this period of time,
There was now-
all you need
And now they make
to do is
But
collect
backcasting, you
like
have
some
to
of
all
all
of this we've done. It was all
One,
individual. Last
2 in this case.
See,
Now
no.
this
got
year
those
made
2
me-
bond coupons,
Like, can you imagine
and
all these maths homework?
subtract the CS coupons on the row.
No.
Here.
My grades would be so much.
But that's, I mean, that's what goes into this line, right? Like
So now you're
the height of this line should be
you could have done it
precisely
down in Python.
No one in my
No,
group
the
reflection
knows
of
Python very well.
the difference
I
of
think it is-
par, which you get back,
And it-
minus where you bought the
I'm not
package,
aiming for a first, like, I'm not exactly.
Plus
I'm trying to
here's
get
the
myself.
the
I'm
coupons
trying to
that
get
you
myself
receive
to
in the
there
bond,
right now, but.
minus the coupons that you
I
paid on
did,
the
I
You
CDS.
can do another master, it's fine, we're on our first, right?
So,
You're on your first, you're on a first.
give it a
That's incredible.
What was
No,
this?
it's our first one.
No, no, it's
Oh,
our
it's-
first
I
one.
think you're
No,
on
I
the first.
am on the first as well, I'm gonna use it.
Depends on derivatives, depends on how.
I'm fine.
So why don't they even fix that?
If the repeat goes well, I might go for a first one. Depends on the NFT.
Products is going to be our Titanic. But even if we survive all of these and like chase these and behavioral at Products, like 92 pages.
Yeah,
Because I have to apply for jobs and stuff as well. I don't have all the time to just like
yeah. How do you do 92?
It's like an essay for my admin.
Yeah, there's been other one on
So is it the second sentence?
Yeah.
For an essay.
Yeah.
assuming that the one principle is
So they don't understand what they want.
It's a bit of a trick question. So when does the bond principle? When could the bond principle get
Well,
reported?
I saw that.
Qualitative.
I saw that deal.
Like,
Which
when
works,
3,000
right?
words qualitative.
And is there any difference
you
between
know.
the default happening in maturity and the bond
My
principle
undergrad
getting
dissertation was
really negative?
26,000 words.
I didn't write it.
Mine was 16 hours.
You did it on the econometrics thing. I remember you in the exam, just like,
Yeah.
and you came into the union like 1 hour after
Yeah,
everyone had
yeah.
left.
You
You get your principle back,
I
yes,
was
but
sitting in the
but there's a default
yeah,
and then your bond
I was sitting in it because I had
CDS makes you up
so
for
I
it,
was
so
just
you
trying
get
to remember the facts.
Who's-
And I was like, I've got half an hour to sit here and
Basically
remember
means
as much as I could.
plotted
And then
out
I
all
saw
the
you,
ways
I
to
was like,
maturity of
what?
this.
Yeah, because it was about the Nicky Bullet test.
Yeah.
this graph and that is
Yeah.
exactly the same.
That was my best exam.
Yeah.
That was the best exam.
So you did Nicky for management, so your management is really hard.
Yeah,
Because
they
then
did
my-
some econometrics.
Is it?
Yeah, they don't cover econometrics in
Ah.
management. Like in economics we cover. I did 2 years of econometrics.
Okay.
Right,
So you guys have some overlap.
Yeah, I done my last year was finance.
I wanna make sure I'm
finance stuff as well.
Okay.
And a lot of macro statistics. A lot of it. Derivatives.
Yeah, a lot of mine was.
Wow, all these modules now are.
Did you not know sleeping and socializing and I'm like, I don't know what actually works. I haven't even started to read my slides.
Wasn't that lecture
What's the right
For these as well.
The bond
Need to go for the lecture here. What is it due next week?
14.
42.
No, 28. In 1 week.
That's, yeah. You're not gonna work on like tomorrow, Saturday, consistency, 1 week.
Exactly. No, I'm not doing work this week. We should work with it together.
I think you should get everyone, get at least
I mean, the old guys.
Max,
Do you
just
want to
get
book
it.
a discussion
Yeah,
next
like
week?
Yes. Oh, wait, sorry.
When are you on campus on Wednesday, right?
I'm on campus. I'm on campus.
Every day.
I need to
Yes.
Big group chat.
Yes. We're all going to get all the same grade.
Actually, pretty
I
dumb.
don't care.
I don't care.
I have the numbers right and everyone just sugarcoat.
But you know, this is like
Yeah, exactly.
people
Just
don't know
just
basically go through
make
this
up
type of
some
exercise.
different words or something.
Yeah, but
Thesaurus,
it's not a bad way of finding out if you enjoy that kind of thing. Just,
It's good practice.
Any other questions?
She's in my Huntington Student Assembly as well.
Okay.
So we
I
went to
haven't,
school
I
together.
haven't
She went to UCL and she's always
Thank you very much.
No problem. So I think
undergrad.
the answers are, I mean, you can make the submit it as just the plots, right?
Yeah,
You
so
don't
like,
have to submit the Excel, but
well, if your plots are wrong, do you not want to see why it went wrong?
well, you'll be able to tell from the
But
plot.
literally my whole life it's always
That's
I
how
already
I
got
get
we have that coursework. And now it's like even more evidence.
Yeah.
Like she was like yesterday she was like having done such
Yeah.
kind of coursework.
Yeah.
I was like, what course? Just
That's the only way I've checked. But I don't know if my rest is.
That's very fun. Yeah.
Okay, thank you.
Sure, no problem.
Hi, sorry, I just want to check this graph, right?
Yeah,
The INST is what, instantaneous, is it?
correct.
So why is there a difference in the minimum point?
Okay, I
Why
have a
would that be a
question for
difference?
you. I was just saying how you're
I
always
think
ahead of
it
me
just
with
takes into
courses
account the
and
carry you've collected up until then.
But it wouldn't be the I assume it's because it's an expiry, you're kind of assuming that the number of defaulters is like continuous and not like discrete at the point of expiry. So a whole bunch of buggers.
So at expiry, so the line at expiry is going to be slightly positive
Oh, I didn't chemistry.
because it adds the time value on top, and then
I just can't
and then
remember
it's
the
like
difference in
and then it's straightforward here, right? Then here, I think it's just because, you know, today if there's defaults,
yeah.
you know, it's not, if there's a default today, the rest of your portfolio reprices as well. It's not like, it's not just linear.
Uh-huh.
It's a bit, it's less, yeah.
I assume it's because like there's a function in the sense that if I have all my 5 defaulters in the case defaulting on the day of expiry versus at the start of the period and then running all the way to expiry, there's a difference in terms of how my spread is cured. And there's an adjustment there. There's probably some difference in the way they plot the graph, in the parameters they use, but I just find it very odd.
So anyway, this difference is the difference in carry you collect, and this difference here, it should also just be that, right?
Yeah. Probably maybe because it's the other way around, because you'll still be paying on the
index.
Yeah, on the index, but you will not be getting on
Yeah.
the charge.
Let me check actually. Let me check how we calculated precisely.
Okay.
and
Another question, just
Yeah.
out of interest. What do you do with GP?
Oh, I work in derivatives research. So I work with Sol, who gives the other.
So in like
Part
credit
of the
derivatives or just derivatives?
Yeah,
as well?
credit derivatives.
Okay, because interestingly enough, I actually have a internship with Barclays. for
Okay.
Credit products.
Ah.
Yeah, so I'm actually looking at what can I do, or what can I look at, or what textbooks can I look at
Yeah.
to try to like expand what I know about the
Yeah, perfect. So I think a really good. So that there's no perfect book
Yeah.
because it's nobody has really just taken on the effort of just writing like a book, and like also the market changes a lot
Yeah.
over time, and like it's not quite the same as it used to be. But my favorite credit derivatives book is the one from O'Kane.
Okay.
Have you
No,
come
I've
across
not
that?
heard.
Dominic O'Kane, and it's called something like single and multi name credit
Yeah, following
derivatives.
single name and multi-name credit
Yes,
derivatives.
that's the one.
Okay, thank you.
So he used to work at Lehman, and he's basically written a book that's got all the theory you need and rigorous, but also like from a practitioner's mindset. So it doesn't like go into too much unnecessary detail
Okay.
and stuff.
Okay.
So this is a really good one.
Okay, thank
And then Schönbucher has written some books, but they are a bit on the theoretical side. I would say.
Okay, thank you.
No worries. So what are you going to do there? Do you know? Are you going to be working on the credit price? Sounds a bit generic.
I'm not sure. They just told me credit products.
Okay.
Yeah.
Is this kind of a summer internship?
It's off cycle. Yeah.
When you start?
I started in June.
Right after the.
Right, literally the week of my test. Yeah, it's my exam week, so it's the moment my exams
Yeah.
kind of end, I'm supposed to start.
Hey, good.
Yeah.
All right, that should be fun. All right, see you next time.
See you.